In the summer of 2024, AMD traded around $100 per share. Nobody was particularly excited about it. NVIDIA was the AI chip darling. AMD was the also-ran. Today, AMD trades above $430. That is a gain of over 430% in less than 12 months. One of the most explosive runs in the history of a major semiconductor company. A single $10,000 investment in AMD at the lows of 2024 would be worth over $43,000 today. So what happened? And more importantly, is the story real? Or is this another AI hype bubble? Today we break down everything. Advanced Micro Devices, AMD, is a semiconductor company founded in 1969 that most people know from one of two things: the Ryzen processors in their laptops or the Radeon graphics cards that gamers use. For years, that was AMD's identity, a scrappy number two behind Intel in CPUs and behind NVIDIA in GPUs. Perpetually catching up, never quite arriving. Then something shifted. In 2023, AMD launched its Instinct MI300 series, AI accelerator chips designed to compete directly with NVIDIA's H100 in data center applications. The MI300 was not just competitive. In some memory bandwidth benchmarks, it beat NVIDIA outright. And that changed the entire investment thesis around AMD overnight. Because suddenly, AMD was not just a PC chip company. It was the only credible alternative to NVIDIA in the most important semiconductor market in the world, the market for AI training and inference chips. That realization, compounded by a series of extraordinary earnings reports, is what drove the 430% run. The surge was not random. It was driven by a sequence of genuine business milestones. It started with the data center numbers. In the full fiscal year 2025, AMD's data center segment generated $16.6 billion in revenue, up 32% year over year, driven by explosive demand for its EPYC server processors and the initial ramp of the MI350 AI accelerator series. In Q4 2025 alone, data center revenue hit a record $5.4 billion, up 39% year over year. Then came the mega deals. Meta Platforms signed a $100 billion deal to purchase AMD Instinct MI4 50 GPUs and 6th generation EPYC CPUs, the largest customer commitment in AMD's history. OpenAI agreed to a 6-gigawatt GPU deployment starting in the second half of 2026. Oracle built an AI supercluster using 50,000 AMD GPUs. AWS launched EC2 instances on 5th generation EPYC processors. The hyperscalers, the companies that control AI infrastructure spending, were no longer just buying NVIDIA. They were buying AMD at scale. The Q1 2026 earnings report in May was the moment that crystallized the story for the entire market. AMD reported revenue of $10.6 billion, up 36% year over year, crushing consensus estimates of $9.84 billion. The data center segment alone came in at $5.38 billion. CEO Lisa Su guided Q2 2026 revenue to $11.2 billion, implying 46% year-over-year growth. She specifically called out 70% year-over-year growth in CPU server revenue for Q2. The stock jumped 21% in a single session following the report, and the broader context amplified everything. The Philadelphia Semiconductor Index is up nearly 47% year-to-date. Intel tripled, Marvel surged. The entire market is repricing the role of semiconductors in AI infrastructure, and AMD, as the clearest NVIDIA alternative, is one of the primary beneficiaries. To understand why AMD deserves to be taken seriously in AI, you need to understand what the MI350 and MI450 actually do. The MI350 series, built on TSMC's 3-nanometer node, delivers 288 gigabytes of HBM3E memory and 8 terabytes per second of bandwidth. AMD claims its MI355X provides 1.6 times the memory capacity and twice the peak performance of NVIDIA's B200 on certain workloads. That is not marketing language. Those are specifications that matter enormously for the large language models that run AI applications. And the MI450, AMD's next-generation chip, goes further. It is built on TSMC's 2-nanometer node, giving it a potential process advantage over NVIDIA's Vera Rubin architecture, which runs on 3 nanometers. If AMD closes the software gap alongside the hardware gap, its competitive position in AI accelerators becomes genuinely formidable. AMD also guided data center revenue to grow more than 60% annually over the next 3 to 5 years, a projection that, if delivered, would make AMD one of the fastest-growing major chip companies in the world. The bull case for AMD rests on 4 pillars. First, hyperscaler diversification is structural, not cyclical. Every major cloud company, Amazon, Microsoft, Google, Meta, has a strategic interest in not being entirely dependent on NVIDIA. AMD is the only alternative at scale. That gives AMD a structural role in AI infrastructure that is not going away regardless of which chip generation wins benchmarks. Second, the EPYC CPU franchise is compounding quietly. While most attention focuses on AMD's AI GPUs, the EPYC server CPU business is steadily taking market share from Intel in data centers. AWS, Oracle, and major cloud providers are standardizing on EPYC. This is a high-margin recurring business that provides a stable earnings floor beneath the more volatile AI accelerator story. Third, the valuation is more reasonable than it appears. At a forward price-to-earnings ratio of approximately 37 times earnings against a projected 40% earnings growth rate, AMD's PG ratio, which compares valuation to growth, sits at around 0.7. For context, NVIDIA's PG ratio is over 1.5. By that measure, AMD is growing faster relative to what you pay for it than its biggest competitor. Fourth, the Sony PlayStation 6 contract. AMD secured the hardware contract for Sony's PlayStation 6, adding approximately $30 billion in semi-custom revenue over the console's lifecycle, a stable, non-AI revenue stream that diversifies the business. Now the bear case, and it is serious. The first and most structural risk, NVIDIA's software moat. NVIDIA's CUDA ecosystem, the software layer that developers use to write programs for AI chips, has been built over 15 years and is deeply embedded in every AI research lab, university, and enterprise AI team in the world. AMD's alternative, called ROCm, is improving rapidly but still trails CUDA in developer adoption, tooling, and compatibility. Hardware performance alone does not win chip markets. Software ecosystems do. And NVIDIA's software lead is arguably its biggest competitive advantage, one that a better chip specification alone cannot overcome. The second risk, China export controls. U.S. government restrictions on exporting advanced AI chips to China cost AMD approximately $800 million in inventory charges in 2025 and reduced its China data center revenue from $390 million to roughly $100 million per quarter. The Safe Chips Act, if passed, could impose a new 30-month freeze on advanced chip exports, a material risk that is only partially priced into the stock. AMD has zero margin for further escalation in trade policy, given how heavily it has concentrated its growth thesis on Western hyperscaler demand. The third risk, TSMC capacity constraints. AMD's entire AI chip roadmap depends on securing sufficient wafer capacity from TSMC at the 3nm and 2nm nodes. TSMC is simultaneously serving NVIDIA, Apple, Broadcom, and dozens of other customers for the same advanced nodes. If AMD cannot secure additional wafer allocation beyond its current commitment, revenue upside is mathematically capped regardless of customer demand. And the fourth, the trailing price-to-earnings ratio of 94 times leaves almost no room for execution mistakes. One product slip, the MI4 5.0 delayed to 2027, a hyperscaler digestion cycle, or a macro slowdown in AI capex, and the stock has significant room to correct from these levels. AMD's 430% run in 12 months is not a mystery. It is the direct result of a company that spent years as a credible number two suddenly finding itself in the right place with the right products at the right moment as the world's largest technology companies race to build AI infrastructure at unprecedented scale. The business transformation is real, the hyperscaler contracts are signed, the technology is genuinely competitive. And CEO Lisa Su has delivered on her roadmap with a consistency that has earned her a reputation as one of the best executives in the semiconductor industry. But 430% in 12 months means the stock has already priced in an enormous amount of that future. NVIDIA's software moat is real. China export risk is real. TSMC capacity constraints are real. And a 94 times trailing earnings multiple means that everything needs to go right for the next several years. AMD is no longer the underdog. It is now one of the most watched, most analyzed, and most debated stocks in the entire market. Whether it earns its valuation from here, or whether the easy money has already been made, is the question that will define the next chapter of this story. Hit like if this gave you a clearer picture of AMD, and subscribe for more deep dives like this one.